Welcome back to Fast Money. We are in the middle of a busy night of earnings. Results are rolling in. Calls are kicking off, but our next guest is on high alert. He says the markets are due for a pullback. Tony Dwyer is Canaccord Genuity's chief market strategist. Tony, great to have you with us.
Thanks for having me, Mel.
Last time you were here, you were sounding, cautious as well. Are you even more cautious than the last time? Can you give us sort of the qualitative measure versus the last time we saw you?
No, it's exactly the same. I think I was on the show the day that we made that tactical downgrade. It's very different than a fundamental downgrade, but it was a tactical downgrade. And actually, Mel, if you look at the indicators that we use then are in the exact same spot, and the indices are in the exact same spot. So it's really hard to say, okay, something's different. And it may be it's frustrating a lot of people that you're just getting this sideways action, but that's what it's been.
Is there anything about earnings season, Tony, that you're watching that could change your mind or maybe makes a stronger case for what you're predicting?
No, Mel, this is not a call that's based upon there's risk in the tape from a fundamental basis. It's not like credit's having a problem. Credit is incredible right now. There's excess liquidity. Earnings are blockbuster. We raised our earnings estimate for 2021 by $2.50 up to 178.50 about a month ago. There's nothing that's saying that this is a horrible environment. You got to be careful. All is lost. It's definitely not that. It's that everything is so good that it creates a condition that's ripe for a pullback. And as you know, one of my favorite lines that we use on the show is corrections only feel natural, normal, and healthy until you're actually in one. And then all of a sudden, when you're down 2%, you start to get scared. So I'd rather be prepared for it, even if it's a little bit early. Honestly, if I'm doing my job right, I've got to be early. I'd rather have people take some profit. This isn't a go short and sell and bet against the market. No way. This is a take a little bit of profit because the market's up so much.
Tony, this is something where, just to dig a little bit deeper about that, you've been on the show for years now. So when you look at some of the other calls that you've had years ago, they seemed a lot more dire to me. So just to piggyback that last answer, can you drill down just a bit more? This doesn't seem that dire. It seems as if you might change your mind you might be more apt to change your mind than you would have in those other downgrades. Would I be correct in saying that? Just give me the difference.
Steve, it's a great question, because this is not what happened in January of 2020. Do you guys remember when the yield curve inverted and the thing that you had on the screen was Dwyer's doomsday clock? Because whenever the yield curve inverts, the U.S. Treasury yield curve inverts, you end up in a recession. This is not that. You do not have tightening financial conditions. Remember, you go into a sustained decline in the economic activity and the market, sustained, when you have a need for money and limited or no access to it. The opposite is true. We have a historic amount of excess liquidity with a synchronized global recovery. But when we got really bullish on offense last May, and the top two sectors since then have been financials and industrials, we all know that the economy is reopening. We all know that you're at a maximum level of monetary stimulus. We know that there's a maximum level of fiscal stimulus that is being proposed. It's not going to go up more. It's probably going to come down a little bit. So, Steve, it's a great question. This is a tactical call based on an extreme overbought condition and excess enthusiasm. This is not a fundamental head for the hills kind of call.
So, Tony, your big call really was, and it stood out for me, and you were great with this one, which was banks and tanks. Where do we stand now? Is there still room, in other words, for that sort of area to go along with cyclicals? Or where do you see some of the best areas right now to have your money sort of shifted over towards in terms of trying to see where the markets go from here? Because we just came through the big earnings season that at least kicked it off with the banks themselves.
Pete, great question. And so I actually think our call on the banks and tanks and energy, materials, the economically sensitive issues, it's a multi-year call. This is not going to be something that is the next 15 minutes for me. I'm not a great trader. I'm pretty good on the intermediate to long term. The bottom line is that until you have this belief that somehow we're going to go back into a recessionary environment, I do believe that you have a good outperformance of the cyclicals. One of the things that we had talked about over the last couple of months, when the U.S. Treasury 10-year Treasury yield was at 177 and everybody was thinking it was going to go to 2%, who in their right mind would believe that it would pull back? And we did. We thought it would pull back. We downgraded the financials on a relative basis. Well, it pulled back. 150 was enough. So a couple of weeks ago, we again turned that call into, I would rather be on a relative basis into the cyclicals, as I said a couple of weeks ago, versus grow. So that might mean in a correction they go down less, but as today was similar to that. But I think that's where you want to be positioned into year end and into next year.
Tony, thank you. Good to see you.
Thank you, Mel.
Tony Dwyer, Canaccord Genuity. We have had a lot of strategists turn more bearish recently. It's not just Tony. We had Mike Wilson of Morgan Stanley last week, I believe it was, Savita Subramanian, Bank of America. Brian Kelly, how do you weigh all of these strategists who are becoming more bearish at a time when the S&P 500 is, as Tony had mentioned, and as Mike Wilson even conceded, the calls haven't worked out yet because the market keeps going higher. So it's tough to stick by this.
Right. But listen, I think all of these calls, and Tony's in particular, when you're talking about it, it's a tactical move. So what does that mean? You made a lot of money this year. Maybe you take off 10%, 20%, book some profits. I think that's probably the move here. If I look at the market and say, what are the dangers out there? I think the biggest danger for the market is that the Federal Reserve is underestimating how tight the labor market is. And you start to get this big wage inflation second half of the year, and a policy mistake comes. We haven't seen that yet, but from where I'm sitting from, that is what would probably stop this rally on a more permanent basis.
Brian, are you in Wyoming now?
I just might be.
I asked that because you mentioned the Fed, and the producer's going to kill me, but I'm thinking about Jackson Hole. And when does Jackson Hole, that confab and typically in Wyoming, right, happen? It happens over the summer, and I'm just thinking about the Fed possibly, using language to indicate that maybe it's going to start tapering its bond purchases sometime this year, which is what a recent Bloomberg survey had indicated the expectations are, and how the market guy would take something like that.
First of all, you're totally in my head because I was going to mention Savita and Mike Wilson last night, so you read my mind. Then I was going to say I would have loved to have seen Montana, which would have made Pete laugh, but I said none of those things. What I will say is take Tony's call. It's a tactical call from somebody that's been spot on for the last couple of years. And what he's saying is be prepared for something that nobody sees coming right now. And that sort of echoes what Mike was saying in Savita last week. So I'm with them. I'm one of these people that think the VIX at 17 and change is too cheap. But I thought the VIX was too cheap at 21 as well.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.